So hello guys, welcome back to my YouTube channel. So today we're going to be talking about DCA. So for people who have been into the crypto space for a long time now, we understand more on DCA. But if you're just hearing the word for the first time, I'm going to be breaking it down in a way that you're going to understand. But before we get right into the video, if you're new to my channel, you can subscribe to the channel. So if I post a video or if I post any video, you can be among the first to get notified. And mind you, when you're subscribing, make sure you turn on the notification so you can receive our notification whenever we post a new video. And if you're returning subscribers, thank you for coming back. So let's get right into the video. So today we're going to be talking about DCA. We're going to be explaining what this is all about, because for a few people who have been to the crypto space, you're going to understand that DCA is a very crucial thing you need to know in the crypto space to help you navigate through your procedures when trading, to avoid excessive loss or to avoid unwanted loss. So I'm going to be breaking down what this is all about in this video in a way that you're going to understand and also know how to apply it to your trade. So before any other thing, let's get straight into the video. So firstly, we're going to be talking about DCA today. DCA, sorry, excuse me. We're going to be talking about DCA. So we're going to be talking about DCA today. Let me enlarge it. So let me make it. So we're talking about DCA today. So what is DCA? For some people, DCA is just a word that they're hearing for the first time. They're not too familiar to it. So I'm going to be breaking down what DCA is before I explain how to amplify it to your trade. So firstly, DCA, which is known as dollar cost average, is a strategy that investors use in the crypto space by purchasing little by little, or by purchasing on certain amount, not going in full time like buying a coin once. Because some people, when they want to purchase a coin, they want to go in completely, like they want to buy a coin, they want to go in 100%. But applying DCA to your trading simply means buying little by little to minimize your losses, or to also help you to buy at any given point. You can buy at even the new high, hoping that even when it dumps, you can still buy extra. When it dumps again, you can still buy extra. But as I said, everything that has an advantage also have a disadvantage. So applying this in your trading, the advantage there is that you can buy at any given point. You can buy at the new high to avoid missing out, and you can also go in when it comes to a zone that you feel like it's a good zone for you to buy. So that is a thing with DCA. But another disadvantage in DCA is that when using DCA to trade, you can go in to buy a coin at a certain zone. Now maybe say you go in with a 40% total of your market cap of your account size. Maybe I say you want to purchase with $1,000 and you prefer to go in $400 first, and you can decide to go in with that $400 and the market can follow from there and make a massive pump. In that way, now you have lose the profit you're supposed to have get. You're still going to gain a profit, but you're not going to gain to compare to when you go in 100%. So that's why I said, as everything has an advantage, it also have a disadvantage. So applying DCA to your trading also implies that you're going to know that sometimes you might end up going into a trade and the trade might pump and leave you, and you might end up making little profits. But the only thing there, that the good thing there is that when the trade is dumping, you have high chance of losing less to compare to losing more when you go in 100%. Because if you're going in little by little, when you notice that okay, the market has broken your zone and is going downward, you can decide to leave the market with the little loss you have. But if you go in 100%, you're going to lose more when you go in 100%. So now advantage. So let's just go into, rather for me explaining more on it, let's just go direct into how to apply it, because I'm very sure that before you come across this video, you might have heard about the DCA and you just want to know how to apply it. So let me make the video short by just going into how to apply it to your trading to help you to minimize losses and maximize your profits. So we're going to be using the BTC USD chart on the Binance. to explain more on this. So checking the USD BTC chart on the Binance. See? Checking the USD BTC chart on the Binance, we can clearly see that the market has been dumping massively for some days now, or for some weeks now. The market has been dumping massively for some weeks now. And for some people, they might predict that the market might not pump again due to the massive dump it has been going, and maybe it might follow from here and begin to reject towards the downside. But looking at the market, we can still tell that the market is still likely on an uptrend. So there's still a high chance that the market might still decide to pump. Because if you're looking at the monthly time frame, if you check the monthly time frame, we're going to figure out that the market hasn't broken any kind of structure that can determine a dump. Like if you should look at the market, if you should see the market, we can clearly see that the market have a lower low here, have a higher low here, and also clearly have an higher high here. It haven't broken any structure to tell that the market is dumping. It just have a key zone here, a liquidity sweep here. This is a key zone and a liquidity sweep here, and begin to dump. So there's still a high chance that the market might decide to reject around this zone here. The market might decide to reject around this zone here. So now here the DCA comes in. When using DCA to trade, here is where DCA comes in now. So now, knowing that the markets might likely reject around this zone, and you want to apply DCA in the sense that you don't want to lose the trade. You are not sure that the markets might reject here, but you still also want to take the trade. In case if the market should reject here, let you partake in it, like let you make a profit from it. But if it does not reject, let you to not lose that much. So therefore, you going in 100% in the trade when you know too well that you are not clearly sure, or the market have not shown you any kind of structure to tell that the market is going to reject from this zone. So going in 100% is going to affect you, and it's going to give you a bigger loss. So therefore, you going in 100%, now you can apply DCA to your trading. Which DCA? You can apply DCA into your trading, and DCA can be applied in different ways. Let's say you have a total account size of $1,000. Let's say you have a total account size of $1,000, and you want to apply DCA to your trading. Rather for you going in with this full $1,000 now to buy a coin, or to buy, say, BTC now at this zone. Rather for you going in fully, you can decide to purchase the coin using DCA. That simply means buying little by little. So let's say now this $1,000, now you can decide to split the money into 3 or into 4. But let's say you split it into 3, and you split the money into 3. That will not mean you splitting this money. That will mean you splitting the money. That will mean you splitting the money into 3, which is $400, $400, $200. Splitting it into 3, $400, $400, $200. For me, I would advise splitting it into 3. Some people might tell you to split the money into 4, but me, I prefer splitting it into 3, because splitting it into 4 is just trying to reduce the profit in case of, if by mistake the market decides to pump from that certain zone, to avoid you losing much profit, or for you to avoid you gaining just little profits. So I prefer dividing the money into 3. So now, if you divide the money into 3, that simply means that the trade you are to take around this zone here, you can decide to go in with $400. You can decide to buy around this zone here. You can decide to buy around this zone here. With $400. Now, if you buy around this zone here with $400, and you still want to buy more, okay, let's say the market now decide to dump a little more again. It dumped to this zone. You can decide that, okay, I'm not going to buy more again. I'm going to wait till I see a breakout to tell that the market is about to pump before I go in fully. So now we can say, okay, let's go and be watching the daily time frame. Let's watch the daily time frame and see when the market break a structure. So let's say after you purchase around this zone here, You buy around this zone here, and the market came around here, the market came to this zone here, test here, and decide to pump. Let's say the market pump and break out from here. You know, now if the market should break out from here and continue pumping like this, that simply means that you have lost your profits, because the market might likely not come back again to test a good zone or to test it again for you to rebuy. So that is why sometimes DCA simply means that you can gain more and you can also lose more, and you can gain less and you can also lose less. I'm sorry for that. You can gain less and you can also lose less applying DCA to your trading. But why people prefer applying it, especially investors in the crypto space, is that it will help you to minimize your losses, and it can also help you to maximize your profits, in the sense that, let's say you buy the market around here and the market decide to make a move like this, maybe come to this fair value gap, test this fair value gap, and decide to dump more. You can decide to go in again with $200. Let's say now you buy in $200 here, and the market now decide to follow from here, pump, break the zone, come back, maybe test somewhere around here, and decide to pump. Now you can decide to find a good zone, maybe a fair value gap, a breaker block, or any reference used in finding your entry. You can decide to find that here using the higher time frame or using the daily time frame, and you can decide to maybe buy the remaining $400 around that zone. Now you have gone in fully, but you are fully assured that the market is going to pump. You are fully assured that the market is going to pump, due to, you know too well that when you are purchasing the market has already give you a clear structure before you go in fully. But if the market did not give you a clear structure and it continue to dump, let's say it dump breaking out the monthly zone, let's say the market continue dumping and dump breaking out the monthly zone, when it break out this monthly zone, what you're going to be losing will just be losses from that $600 that you use in purchasing. So now for you to be having loss, let's say you are losing 10%, that 10% will be $60. Now for you to be losing $100 when you're losing 10%, now for you to be losing $100, you're going to be losing $60 because you did not go in completely. But if you had gone in completely, you're going to lose extra $40 because you're going to be losing $100. But applying with DCA is going to help you to lose less. It's going to help you lose less. And sometimes it can also help you make more profits than losing less. If the market should play out, so it can also help you make more profits. Because let's explain now. Let's say you bought around here. Let's say you bought some around here, and the market decides to dump more. You know, if you should buy 100% here, when the market dump more, you are on loss. You are losing. The market should dump here, you're already on loss. So the market have to come back over the zone here for you to be back on profit. But if you should buy with DCA now, let's say you go in here with $400 and the market decides to pump and come down again. When the market dump again, you can go in with $200 now. If the market to begin to pump from there, that $200 begin to give you profits before it even break out from the zone that you bought with $400. So now you're making profit with the $200 and you're also making profit from the $400. When the market decides to break, sometimes it can come to sweep liquidity, or you can actually use a lower time frame. That will be another video. I'm going to explain how to navigate your time frame using from the monthly time frame, navigate to the daily time frame, from the daily time frame navigate to the 1 hour time frame to buy a coin in a way that you can reduce your risk. Because buying coins, sometimes I prefer buying using the derivative market than going for the spot. But if I go for the spot, I prefer buying with margin. So applying margin in your trade in a way that you can be able to still make more profits and avoid losing much, because buying with the spot market directly will reduce your profits. But if you're buying with margin, it helps you give you more profits in the market. So buying with margin is going to help you with more profits, and also it's going to help you make more money than the amount you're going to make. So if you're using margin to buy here now, using margin to buy here now will help you to make more profits than the amount you're supposed to have make if you are to buy with just the normal spots market. So using the DCA, though the DCA work more on the sports market to other markets, because you cannot buy, you can't buy twice. Let me say you're trading the derivative market, you cannot use the DCA on the derivative market. Or if you're trading something like the DeFi, or you are trading the Gen market, the meme coin, you cannot apply DCA. But though you can still apply DCA on the Gen market. Let's say you're trading Solana meme coin, you can still apply DCA on the Solana meme coin and also still make more profit trading Solana meme coin. But most time I don't advise using DCA on the Solana meme coin, especially due to the volatility of the market. The market can be very volatile sometimes, so you just want to go in, make some profit, and get off the markets before it crash on you. So mostly when applying DCA, I will advise use it more on the spot markets. Even if you want to maybe try applying it in other categories or other places, me, I will apply you use it more on the spot market. And most times safe people use this DCA safe on the forex market without knowing that they're actually using the DCA on the forex market. Because let's say someone now, let me go into, let's say someone trying to trade. Let me use a coin that I have an analysis on already. So let's use this. So let's say someone who is trying to buy a coin now on this market now. You're trying to buy a coin here, and you're trying to make the best out of it. You're trying to make the best out of it on this coin. No, I don't have a clear analysis on this. Let me check this. Okay. Or we can just go with the first one I checked. Let me just go with something I don't have any analysis on, so it's been more understandable for us. Okay, let's work with this. So let's say you're trying to trade USDT JPY, and you are not clearly assured that if the market should test this certain zone, it's going to pump from there. So let's go to the lower time frame. Let's go to 5 minutes, so we can be able to just quickly scroll through the charts, so I can use to explain what I'm trying to explain. That you can also apply the DCA on the forex market. In fact, a lot of people apply DCA on the forex market without knowing that they're actually applying it. So let's say you're trying to go into this trade now. DCA, so if you can still apply DCA on the forex market, in the sense that there's a fair value gap here, and you're trying to avoid missing the market, you can decide that, okay, I'm going to go in using this fair value gap here and put my SL below this zone here. But you know too well that the market might likely want to come and test this little fair value gap around this zone here. Though sometimes it doesn't come this low, but sometimes it come way below that. And you don't want to go into the trade and just making just 1x, because if you go in on with this, you're just going to make 1x out of the market, and you don't just want to make 1x. So you can decide to say, okay, if I'm to buy this coin with $1,000 now, I can go in with $400 here and wait and see what happens. When the markets come down to test this zone, you can go in again with another $400, or you can go in with $300. Then if the market break a structure, break to the upside, maybe you check the 1 minute and the market breaks structure to the upside, you can decide to go in with the remaining amount to make sure that you make the best out of it. Or you can decide to wait till we break a structure and you go in. It depends on the trading strategy, but some people prefer applying even that DCA on the forex market without knowing that they're applying it. So DCA is a very good and crucial thing to know when it comes to the trading market, because I trade both the forex and the crypto market, and with my experience, I can tell you that it is very, very crucial, especially when it comes to spot bargain. It's going to help you to make the best. So I'm going to end this video here, and on another video, I'm going to be talking about how to apply time frame on your trade and how to use time frame to make more profits on the market. And I'm going to also be talking about how to understand your trend line on another video. So in case if you don't want to miss out on that, you can subscribe to our YouTube channel so you will not miss out on that. Thank you for watching this. Have a nice day.